time now to get in Mr. Sashi Krishnan. He's CIO, Chief Investment Officer at Birla Sun Life Insurance. Chemical engineer, that's what he studied. Then he went on to become an economist. He understands finance, has had, I think, more than 25, 30 years of investment experience as an insurance, as someone who handles insurance money. What is happening with insurance money right now, Mr. Krishnan? What kind of money is coming into insurance funds? How much money are you managing right now?
So we manage something like around 33,000 crores of assets. And we manage money both in our traditional funds and in our unit-linked insurance plans. And I think the trend that we've seen over the last few years has been there has been more money coming into traditional funds than money going into unit-linked insurance plans. But you know, with this capital market revival, we are suddenly seeing a renewed interest which policyholders have in unit-linked funds. And a lot of policyholders now believe that they can use the unit-linked funds, as a wealth creation vehicle, especially as, the future looks fairly bright. If you're looking at a 15, 20-year perspective, because that's the nature of the, liabilities that we sort of have and the kind of money that we manage.
So when you have that kind of money which allows you to take a much, much longer term call, except that some of the ULIPs tend to be shorter term, right?
No, so very typically most investors who get into unit-linked insurance plans need to stay locked in for a 5-year period.
Yeah.
But it is not necessary that they move out of these ULIPs, especially people who have done their financial planning right. They do tend to stay for 15, 20 years in ULIP plans also.
So effectively, a ULIP is more beneficial to you because the return that you give on a ULIP is slightly lower, right? In terms of the premium is slightly higher. It's almost like a mutual fund. But whereas the funds that come in for long term, that someone dies, gets money, it has a longer term period, but effectively you have to pay out more than you get in premium, right?
No, so I think it depends on the need that a customer has, the need that a person who's purchasing a policy has. For example, if he wants both protection as well as participation in the markets, then the ULIP is actually an extremely good plan because he gets the benefit of both. But if he's just looking for protection, many of them actually buy into our traditional plans.
Right.
So I think it's purely a function of what the customer is looking for. And I think given the fact that we are seeing increasing household savings participating in the capital markets, I do believe that ULIPs actually have a very important place to play in the portfolio of any retail investor.
Just for a person who actually has fund inflows, and in terms of payout, you don't have the kind of redemption pressure that a lot of mutual funds would have. You don't have the dividend payout pressure that mutual funds would have. You can afford to be much more long term than others, right? So I just want to understand how a person who does investment, a person like you, how do you view the markets? You've done it for years. How do you view the current markets?
So you're perfectly right over there because the nature of the liabilities in insurance is primarily long term. And therefore, it affords us as fund managers in insurance to take a much longer term view in terms of what we see as the prospects of the company and not get too worried about, volatility, because unfortunately, a lot of action in this market gets driven by, short-term volatility and, news flows, which, we are, for example, we can sort of avoid. And therefore, it is possible for us to take a much, much longer-term view on the India story. And get into stocks which we do think that over the next 15, 20 years will deliver significant return to customers. So if you look at equity markets itself and you look at the sort of 15-year sort of CAGR that equity has given investors, it's in the region around 15, 17%. And if you compare that with any other asset class that an investor has the opportunity to get into, it is actually significantly better. It not only protects you against inflation, which has been fairly high in India, but gives you a real rate of return that is fairly significant. And that's, I think, the opportunity that customers have, policyholders have when they get into insurance and participate in the capital markets through our insurance funds.
Mr. Krishnan, the reason I was asking you this is essentially that a lot of mutual funds have to play momentum because they have redemption pressure. There is money which comes out. Retail investors can say, okay, I am happy now, I want to take it out. They have flows when they probably don't want to invest also. But for a person like you, is it essentially just earnings? Because you are so long term, you can't afford to have play momentum.
So you're right. So when we look at investing into or building up a portfolio of equity stocks, we would look at sustainable earnings that companies can give us. I think importantly, the other point I want to make is by the very nature of the product which we have in insurance, they are true systematic investment plans because customers put in new premiums on a regular basis every 6 months, every year, over a 10-year period. And therefore, the customer actually doesn't have any need to time the market as such because he is a systematic investor in our funds. And for us, I think long-term sustainable earnings is something that is very, very key to how we look at building up our portfolios rather than trying to play momentum. Yes, we may trade to the extent of 5–10% of our portfolios just for opportunities or markets get extremely overvalued. But primarily we would just play the sustained earnings story when we invest.
Warren Buffett once said that I'd rather take lumpy, high growth, which is lumpy, that is, it has its ups and downs, than have a stable, continuous growth. But for an insurance fund, would you follow that same principle that a 10-year average is what you're looking at and you don't really care about stability over a period of time?
Yeah, so you're right. So very often, we tend to, investors in this market tend to get sort of swayed by, momentum, or they get swayed by valuations. So these are two things that, though we will look at very carefully, if we see sustained earnings, and we do believe that, valuations today may be looking expensive, but because we intend remaining in the stock for the next 15 years, and we know that this kind of earnings justifies the kind of valuations that we have today, there is no reason why we won't get into that stock today and hold on for the next couple of years. Secondly, a couple of quarters of bad earnings actually doesn't unfaze us too much, because if we believe that intrinsically this is a good management, follows the best corporate governance practices, has built up a business model that will sustain into the future, a couple of quarters of bad earnings, primarily because of the external environment, doesn't bother us too much, and we will continue to hold.
So I know when you're a fund manager, when you have overseeing funds and you have assets under management, the more the funds come in, obviously the more exciting it gets. But it also probably increases your, BP probably, because you are seeing a market where valuations are stretched, where earnings visibility is slightly, is slightly pushed to the future, and yet you have to invest. So what are you doing right now?
Yeah, so that's a very, very interesting question, because I think what's driven markets primarily are three things. One is obviously earnings expectation, as you very rightly put it. Second is the domestic macros. And third is the global macros. And if you look at all the three, obviously it does look as if markets have moved into a slightly overvalued zone. Because if you look at global macros, I think the primary driving force has been global liquidity. And as you were mentioning a few minutes back, we're looking at immediate events like, the Bank of Japan or the Fed, either increasing rates or tightening or whatever it is. And therefore, markets tend to react. But from a longer-term perspective, if you look at it, especially in the US, with a lot of things falling in place, with inflation coming back, with growth coming back, with the unemployment levels dropping, it is but natural that you will get into a a rising cycle of interest rates, and I don't think from a longer term perspective markets are going to get too worried about it. As if you look at domestic macros, everything has fallen in place over the last last 2 years or so, and we've got low inflation, we have fiscal deficit under control, we have the reform process taking off, and therefore markets are now a little worried as to what next. But if you look at it over a 5-10 year period, like we in the insurance look at it, if we see sustained growth of 8-10% over the next couple of years, I think it will clearly reflect in corporate earnings. Finally, coming to corporate earnings, we do believe that we are going back to a path of something like 15-16% earnings growth over the next couple of years. And if you track earnings growth and the kind of returns that equity markets have given, you will find that equity returns very closely track earnings growth. So in the early part of the 2005 part, when earnings was growing at something like 20-25%, markets also gave very, very similar returns. And therefore, I do believe that when we get back to 14, 15, 16% earnings growth over the next 2-3 years, equity markets will also reflect that same kind of return that investors can get. And therefore, we wouldn't be too worried about earnings growth, but I do think that the immediate triggers for any sort of up move in the market will have to be better earnings growth in the next 3 quarters.
But right now, earnings growth, are you happy with what has happened, what we're getting in terms of the first quarter earnings? Because, I was looking at 2 reports. One suggests that first quarter earnings, if you keep banks in it, the increase is just 1.6% for the Nifty. If you exclude banks, then it's about 3.5%. And the estimates excluding banks was about anywhere between 7 to 8% earnings growth. If I look at the impact of INDAS, the Mint has today reported a KPMG report that the impact of INDAS has actually been good in accounting terms in showing higher earnings growth than what the previous accounting system would have allowed. So it's a double whammy, which seems to suggest that earnings growth has still not picked up.
Yeah, so I mean, if you look at it in the way you put it, I do agree from an aggregate basis, you have a 1.5 to 1.8% earnings growth. But if you disaggregate it, you will find that there are a set of sectors that have actually given you almost a 20% earnings growth. Sectors like cement, sectors like consumers, if you look at the next level, you will find like sectors like the IT have given you earnings growth of something like around 10%.
Right.
If you look at the banks, they've actually given you a negative growth of 18%. So at an aggregate level, you are finding that earnings is stuck at around 1.5, 1.8%. But at a disaggregated level, you are seeing sectors that are actually doing very, very well. And I think in this kind of market, if you can identify those sectors where you will see a quick recovery in the earnings growth and invest into them at this point of time, you will be able to make money for your investors. So let me having said that,
sorry, go ahead.
Having said that, I think for the having said that, I think if you look at earnings for FY17 and earnings for FY18, we do expect earnings to recover to around 14% in FY17 and something like around 17% in FY18. And I think the first quarter is obviously... So you actually expect a very good second and third quarter and even better fourth quarter, because fourth quarter FY16 was pretty good, right? Yeah. Yeah, so we do expect that recovery to happen, because I think there are still, if you look at, if you sort of investigate earnings in this particular quarter, though we have not had too much of revenue growth, what we have found is that the margins have actually remained very, very healthy. And if we have a continued healthy margin over the next 2 quarters, and we see, revenue growth improving because of a better monsoon, because of, higher consumer spend, and the fact that margins remain where they are or improve because commodity prices are still very, very easy, I would think that the third and the fourth quarter should be fairly good, and we could get back to 14% earnings growth in FY17.
Okay, I just want to take up the individual sectors that you mentioned. Cement, are you still bullish on it with a 1 to 2 year period?
Yes, we are, because I think there will be two drivers in the immediate term for markets. As I told you, one will be the fact that whatever the drivers of economic growth, which will primarily come from the investment side, and therefore I think cement falls into that category, will be one area which we think will do very well. And the second will be the consumption side, because we see consumption coming back quite strongly post monsoon, post the CPC and all that.
So consumption is a very wide band. Is there anything we would like to pick out from that? In consumption, are you with consumer durables? Are you with non-durables? Are you with FMCG? Which side?
So, I mean, primarily, you'll have sectors like, the automobiles and the rest of them doing, which we believe well. But very quickly, getting back to cement, I know that, valuations have moved up quite significantly. Right. But you have to realize that, the cement sector is still operating at, 70-75% capacity utilization. And still there's a lot of space for, capacity utilization to improve as the investment cycle picks up. And I think that will also, keep earnings where they are. But yes, many of these sectors do look expensive. And, at this point of time, we will obviously be looking at, some value or any correction in the market which will afford us an opportunity to get into these sectors.
Mr. Krishnan, anything where you have a counter-intuitive call, which is against the grain of where the markets are moving, any sector?
So, I think one sector which we are still a little cautious about is in the public sector banks, because while we think that, maybe 2 quarters down the line, the public sector banks could lead this market. At this point of time, we'd like to watch a couple of more quarters, especially in the, the mid-cap banking space, to see how their balance sheets are correcting.
Is there a counter-intuitive, is there a counter-market call to be taken in IT or in capital goods right now? Have they corrected enough?
Yes, in fact, if you look at it from a valuation perspective, the IT pack is quoting at something like 16 times 1 year forward, whereas the market's actually quoting at something like 19 times 1 year forward. So obviously, after a very, very long time, IT is actually quoting at a discount to the broad market. Yeah. But, especially from after looking at the kind of sort of tentative views that some of the IT companies have expressed over the last 2-3 weeks, primarily saying that they see a slowdown in the BFSI space. That's something that we'd like to, watch over the next, at least till this end of the quarter, the December quarter, to see whether, whether there is actually a slowdown or, the recovery will happen sooner than later.
Sashi Krishnan, thank you so much for joining us. Pleasure talking to you. Thank you for taking out time for us.